Hello students, welcome to the lecture on pre-shipments, finance and post-shipment credit, and after this lecture we will be able to learn the following objectives. Discuss the types of pre-shipment credit, define the trade financing instruments, explain the pre-shipment credit or packing credit, describe the pre-shipment credit in foreign currency, understand the post-shipments finance, explain the post-shipment credit guarantee and bank guarantees. Let's start with the concept of pre-shipment finance and post-shipment credit. A prerequisite to avail of pre-shipment financing is that the exporter should have a credit facility in place with a bank. Each bank has a credit process that determines the amount of funding the bank can give the company. Pre-shipment credit is offered to an exporter by way of packing credit to enable him to finance purchase or import of raw materials, processing and packing of the goods meant for exports. Post-shipment finance is a kind of loan provided by a financial institution to an exporter or seller against a shipment that has already been made. This type of export finance is granted from the date of extending the credit after shipment of the goods to the realization date of the exporter proceeds. Exporters do not wait for the importer to deposit the funds. Now moving on to the next topic, we will discuss the types of pre-shipment credit. These are two types of pre-shipment credit. Number one, packing credit, and number two, advance against checks or draft, etc., representing advance payment. Packing credit. This facility is provided to an exporter who satisfies the following criteria. A 10-digit importer-exporter code number allotted by DGFT. Exporters should not be in the caution list of RBI. If the goods to be exported are not under OGL Open General License, the exporter should have the required license or quota permit to export the goods. Packing credit facility can be provided to an exporter on production of the following evidences to the bank. Formal application for release the packing credit and undertaking to the effect that the exporter would be shipped the goods within stipulated due to date and submit the relevant shipping documents to the banks within prescribed time limit. Firm order or irrevocable LC or original cable, fax, telex, message exchange between the exporter and the buyer. Advance against check or drafts received as advance payment, where exporters receive direct payments from abroad by means of checks or drafts, etc. The bank may grant export credit at concessional rate to the exporters of goods track report till the time of realization of the proceeds of the checks or draft, etc. The banks, however, must satisfy themselves that the proceeds are against an export order. Trade financing instruments. The main types of trade financing instruments are documentary credit. This is the most common form of the commercial letter of credit. This issuing bank will make a payment either immediately or at a prescribed date upon the presentation of stipulated documents. These documents will include shipping and insurance documents and commercial invoices. The documentary credit arrangement offers an internationally used method of attaining a commercially acceptable undertaking by providing for payment to be made against presentation of documentation representing the goods, making possible a transfer of title to those goods. A letter of credit is a precise document whereby the bank extends credit to the importer and assumes responsibility in paying the exporter. A common problem faced in emerging economies is that many banks have inadequate capital and foreign exchange, making their ability to back the documentary credits questionable. Counter trade. As mentioned above, most emerging economies face the problem of limited foreign exchange holdings. One way to overcome this constraint is to promote and encourage counter trade. Today's modern counter trade appears in so many forms that it is difficult to devise a definition. It generally encompasses the idea of subjecting the agreement to purchase goods or services to an undertaking by the supplier to take on a compensating obligation. The seller is required to accept goods or other instruments of trade in partial or whole payment for its products. Factoring. This involves the sale at a discount of accounts receivable or other debts asset on a daily, weekly or monthly basis in exchange for immediate cash. The debt assets are sold by the exporter at a discount to a factoring house, which will assume all commercial and political risk of the account receivable. In the absence of private sector players, governments can facilitate the establishment of a state-owned factor or a joint venture set up with several banks and trading enterprises.
Today we're going to answer a simple question. What is factoring? Factoring is a business financing tool that helps small business owners that have cash flow problems. Small business owners often have to give their customers terms, that is, the option to pay an invoice in 30 to 60 days. The problem is that they can't afford to wait that long for payment. They need the money sooner so that they can cover their own expenses. Factoring works by financing those open invoices. This gives the business owner the money they need to operate their business while they're waiting for their customer to pay. The transaction settles once the end customer pays the invoice in full after 30 or 60 days. Let's go to the whiteboard so that I can show you how a transaction works. This is Jack. He owns Jack Inc. and he's been working with his customer. They have a great relationship. However, the customer is paying his invoices in 30 days and Jack needs the money sooner so that he can pay his employees and his suppliers. So as step number 1, he would submit the invoice to the customer, just as he would normally do. As step number 2, he sends the invoice to the factoring company. The factoring company processes the invoice, and as step number 3, advances the money to Jack. This is when Jack gets the money he needs to operate his business. The transaction settles once a customer pays the invoice in full as step number 4.
Pre-shipping financing. This is financing for the period prior to the shipment of goods to support pre-export activities like wage and overhead costs. It is especially needed when inputs for production must be imported. It also provides additional working capital for the exporter. Pre-shipment financing is especially important to smaller enterprises because the international sales cycle is usually longer than the domestic sales cycle. Pre-shipment financing can take in the form of short-term loans, overdrafts, and cash credits. Post-shipping financing. The ability to be competitive often depends on the trader's credit term offered to buyers. Post-shipment financing ensures adequate liquidity until the purchaser receives the products and the exporter receives payment. Post-shipment financing is usually short-term. Let's know the meaning of pre-shipment credit or packing credit. Pre-shipment or packing credit means any loan or advance granted or any other credit provided by a bank to an exporter for financing the purchase, processing, manufacturing or packing of goods prior to shipment on the basis of letter of credit opened in its favor or in favor of some other person by an overseas buyer, or a confirmed and irrevocable order for the export of goods from India, or any other evidence of an order for export from India having been placed on the exporter or some other person, unless lodgement of export orders or letter of credit with the bank has been waived. Period of advance. The period for which a packing credit advance may be given by a bank will depend upon the circumstances of the individual cash, such as the time required for procuring, manufacturing or processing where necessary and shipping the relative goods. It is primarily for the banks to decide the period for which a packing credit advance may be given, having regard to the various relevant factors, so that the period is sufficient to enable the exporter to ship the goods. If pre-shipment advancements are not adjusted by submission of export documents within 360 days from the date of advance, the advances will cease to qualify for concessive rate of interest to the exporter ab initio. RBI would provide a refinance only for a period not exceeding 180 days. Disbursement of packing credit. Ordinarily, each packing credit sanction should be maintained as a separate account for the purpose of monitoring period of sanction and end use of funds. Banks may release the packing credit in one lump sum or in stages as per the requirement for executing the orders or LC. Banks may also maintain different accounts at various stages of processing, manufacturing, etc., depending on the types of goods to be exported, example, hypothecation, pledge, etc. accounts, and may ensure that the outstanding balance in accounts are adjusted by transfer from one account to the other, and finally by proceeds of relative exports documents on purchase, discount, etc. Banks should continue to keep a close watch on the end use of the funds and ensure that credit at lower rates of interest is used for genuine requirements of exports. Banks should also monitor the progress made by the exporters in timely fulfillment of export orders. Liquidation of packing credit. The packing credit or pre-shipment credit granted to an exporter may be liquidated out of proceeds of bills drawn for the exported commodities on its purchase, discount, etc., thereby converting pre-shipment credit into post-shipment credit. Further, subject to mutual agreement between the exporter and the banker, it can also be repaid or prepaid out of balances and exchange orders of foreign currency, AC, PEFC, AC, as also from rupee resources of the exporter to the extent exports have actually taken place. If not so liquidated or repaid, banks should charge a rate of interest for export credit not otherwise specified ECNOS pre-shipment as indicated from the date of advance. Packing credit in excess of export value, whereby product can be exported, where the exporter is unable to tender export bills of equivalent value for liquidating the packing credit due to the shortfall on account of wastage involved in the processing of agro products like raw cashew nuts, etc. Banks may allow exporters inter alia to extinguish the excess packing credit by export bills drawn in respect of byproduct like cashew, shelled oil, etc., where partial domestic sale is involved. However, in respect of export of agro-based products like tobacco, pepper, cardamom, cashew nuts, etc., the exporter has necessarily to purchase a somewhat larger quantity of the raw agriculture produce and grade it into exportable and non-exportable varieties, and only the former is exported. Export of de-oiled deflated cakes. Banks are permitted to grant packing credit advance to exporters of HPS groundnut and de-oiled deflated cakes to the extent of the value of raw materials required, even though the value thereof exceeds the value of the export order. Banks have, however, operational flexibility to extend the following relaxation to their exporter clients who have a good track record. Repayment or liquidation of packing credit with proceeds of export documents will continue. However, this could be with export documents relating to any other order covering the same or any other commodity exported by the exporter. While allowing substitution of contract in this way, banks should ensure that it is commercially necessary and unavoidable. Banks should also satisfy about the valid reason as to why packing credit extended for shipment of a particular commodity cannot be liquidated in the normal method. As far as possible, the substitution of contract should be allowed if the exporter maintains account with the same bank or it has the approval of the members of the consortium, if any. Running account facility. Pre-shipment export credit facility in respect of any commodity without insisting lodgement of LC or export orders, which should be produced within a reasonable period of time to be decided by the banks. This facility is being extended only to those exporters whose track record has been good, as also to EOCUs, units in free trade zones, EPZs and SEZs. Running account facility should not be granted to sub-suppliers. Rupee pre-shipment credit to specific sectors or segments. Banks are permitted to grant rupee export packing credit to manufacturers, suppliers for exports routed through STC, MMTC, other export houses, agencies, etc. Such advances will be eligible for refinance subject to some condition, including obtaining a letter from the export house setting the details of the export order, etc. The PCFC facility is granted to exporters in foreign currency for domestic and imported inputs of exporter goods at LIBOR, Euribor related rates. This is an additional window for providing pre-shipment credit to Indian exporters at internationally competitive rates and applicable to only cash exports. The exporter will have the following option to avail of exports finance. To avail of pre-shipment credit in rupees and then the post-shipment credit either in rupees or discounting, rediscounting of export bills under rediscounting of export bills, a broad scheme EBR dealt separately, to avail of pre-shipment credit in foreign currency and discount or rediscounting of the export bills in foreign currency under EBR scheme. Period of credit. The PCFC will be available for a maximum period of 360 days. Any extension of the credit will be subject to the same terms and condition as applicable for extension of rupee packing credit, and it will also have additional interest cost of 200 basic points above the rate for the initial period of 180 days prevailing at the time of extension. Further extension will be subject to the terms and conditions fixed by the bank concerned, and if no export takes place within 360 days, the PCFC will be adjusted at TT selling rate for the currency concerned. Post-shipment credit means any loan or advance granted or any other credit provided by an institution to an exporter of goods from India from the date of extending credit after shipment of goods to the date of realization of export proceeds. Types of post-shipment finance. The post-shipment finance can be classified as export bills purchased or discounted, export bills negotiated, advance against export bills sent on collection basic, advance against export on consignment basic, advance against endrawn balance on exports, advance against claims of duty drawback, export bills purchased or discounted, DP and DA bills. Export bills are used in terms of sale, contract or order may be discounted or purchased by the banks. It is used in indisputable international trade transaction, and the proper limit has to be sanctioned to the exporter for purchase of export bill facility. Export bills negotiated billed under LC. The risk of payment is less under the LC as the issuing bank makes sure the payment. The risk is further reduced if a bank guarantees the payments by confirming the LC. Basic features of post-shipment finance. The features of post-shipment finance are: purpose of finance. Post-shipment finance is meant to finance export sales receivable after the date of shipment of goods to the date of realization of exports proceeds. In cases of deemed exports, it is extended to finance receivables against supplies made to designated agencies. Basic of finance post-shipment. Finances are provided against evidence of shipment of goods or supplies made to importer or seller or any other designated agency. Types of finance. Post-shipment finance can be secured or unsecured. Since the finance is extended against evidence of export shipment and bank obtains the documents of title of goods, the finance is normally self-liquidating. In that case, it involves advance against undrawn balance and is usually unsecured in nature. Further, the finance is mostly a funded advance. In few cases, such as financing of project exports, the issue of guarantee, retention money guarantees is involved, and the financing is not funded in nature. Quantum of finance. As a quantum of finance, post-shipment finance can be extended up to 100% of the invoice value of goods. In special cases where the domestic value of the goods increases the value of the exporter order, finance for a price difference can also be extended, and the price difference is covered by the government. This type of finance is not extended in case of pre-shipment stage. Banks can also finance undrawn balance. In such cases, banks are free to stipulate margin requirements as per their usual lending norm. Deem exports, rupee export credit at prescribed rates. Banks are permitted to extend rupee pre-shipment and post-supply rupee export credit to parties against orders for supplies in respect of projects aided or financed by bilateral or multilateral agencies or funds including World Bank, IBRD, IDA, and considered as deemed exports. Interest rate on rupee export credit. Interest rates applicable for all tenors of rupee export credit advances are at or above base rate. Prior to the period, it was not exceeding BPLR minus 2.5% per annum. If pre-shipment advances are not liquidated from proceeds of bills on purchase, discount, etc. on submission of export documents within 360 days from the date of advance, advances will cease to qualify for prescribed rate of interest for export credit ab initio. Such credits will be termed as export credit not otherwise specified ECNOS, and banks may charge interest rate prescribed for ECNOS pre-shipment. If exports do not materialize at all, banks should charge on relative packing credit domestic lending rate plus penal rate of interest, if any, to be decided by the banks on the basis of a transparent policy approved by their board. Packing credit sanction, if any, to an exporter is treated as repaid once the exporter effects the shipments and submits the export's documents to the bank. If the exporter intends to continue the credit facilities till the value of shipment is realized from the foreign buyer, he has to avail of post-shipment credit. The post-shipment credit guarantee provides protection to banks against non-realization of export proceeds and the resultant failure of the exporter to repay the advances availed. A bank guarantee is a pledge on the part of a bank to make someone's debt good in the event that he or she cannot pay it. Bank guarantees are essentially like agreements to stand as a consignor on a transaction in the event that the original party cannot follow through. The bank can be called upon to provide the payment. Many banks offer bank guarantees as a service to their customer for the purpose of facilitating large business operation and deals, and this particular banking tool is primarily used by big customers such as corporations and governments. From the perspective of a seller in such transaction, a bank guarantee is a letter of surety. It means that if the buyer takes possession and fails to pay, the seller can still recover the payment from the buyer's bank. Bank guarantees may be used in situations where large amounts of financing are needed and it is not possible to obtain a loan from one location, as for example, when the World Bank provides a bank guarantee for a development project and for deals on a smaller scale.
Committed to conclude your trade deals. Bank guarantee, or MT-760, is an irrevocable commitment issued by a bank on behalf of their client who came into an agreement or contract with a supplier to purchase certain merchandise and promised to meet all financial obligations to the supplier in the event of default. Bank guarantees can also be used to improve the credit ratings of the issuing parties and can provide backup facilities for loans granted by third parties. Here are the step-by-step procedures to obtain BG from Brunswick Trading. First, buyer will submit pro forma invoice or sales and purchase agreement of their trade deal to Brunswick Trading. Brunswick Trading will review and carry due diligence of the transaction between buyer and seller and will inform the concerned parties whether their BG application is approved or rejected. Once the BG application is approved, the buyer will provide certain documents such as 1. Company's registration or trade license copy. 2. Company's MOU between partners, if any. 3. Authorized signatory's passport photocopy. 4. Utility bills proving the authorized signatory's residence address and company address. 5. Latest 6 months bank account statement copy. 6. VAT registration and compliance documents, if applicable. And pays the BG issuance fee charges to Brunswick Trading. Once all documents and payments are received, Brunswick Trading will immediately act and will provide from their bank the required BG on behalf of the buyer and in favor of their supplier to conclude.
Now in the end, let us summarize what we have learned in this lecture. Pre-shipment credit is offered to an exporter by way of packing credit to enable him to finance purchase or import of raw materials, processing and packing of the goods meant for exports. A financial arrangement whereby a financial institution in the exporting country extends a loan directly or indirectly to a foreign buyer to finance the purchase of goods and services from the exporting country. Post-shipment finance is a kind of loan provided a financial institution to an exporter or seller against a shipment that has already been made. Bank guarantees are essentially like agreements to stand as a consignor on a transaction in the event that the original party cannot follow through. The bank can be called upon to provide the payment. Post-shipment finance given to the exporters by banks through purchase, negotiation or discount of export bills or advances against bills sent on collection basis qualifies for this guarantee.